So I'll jump right into it, and to the extent that any of y'all want these two PowerPoints, I can email them to you, or the builders can. So first is business climate rankings, and this is not a puff piece for South Carolina. Some of these rankings are very bad. Some of them are very good. But Site Selection does a couple of things. Do an annual ranking, and this is 2024 for Site Selection. Georgia was number 1, North Carolina was 4, South Carolina was 5. And one problem with these rankings is that North Carolina and Georgia always do extremely well. So even when we do well, Georgia and North Carolina are right there. So Site Selection, so we were 29th in business tax climate, 30th in higher ed, 13th in industrial power. So they also, Site Selection also do a survey of Site Selection consultants. And so the consultant said South Carolina was best for manufacturing, number 1 in the country, number 8 for top state business climates, and number 3 for best manufacturing workforce. So Chief Executive is another ranking. This is their 2024 ranking. South Carolina was 10th on that. Texas is number 1. Texas and Georgia sort of swap number 1s in most of these rankings. Chief Executive, we were 8th in 23, 12th in 22. So area development, this one just came out. And I'm a little skeptical of some of these rankings, but nevertheless. So we were 2nd overall, which is obviously fab, but unfortunately Georgia was 1st and North Carolina was 4th. 6th overall cost of doing business. 5th access to qualified labor, which is probably a shock to y'all. It ain't easy to get qualified labor. All right, and so first in cooperative and responsive state government, state and local government, which is probably a shock to y'all. Not ranked in corporate tax structure. Everybody thinks we have the best tax system in the country. Well, we don't. We weren't ranked. 5th, tied for 5th for favorable property tax environment, which is completely wrong. It's a good ranking, but South Carolina is not that good on property tax. So I don't need to tell y'all. I can't get it to move forward. Y'all.
I don't know how to do PowerPoint.
Either that or that. This was working. It's frozen now.
Let me see if you can.
Yeah.
How about if we just
Yeah, so I'll just click that.
Okay.
So this is what we've already been over. So I'm going to skip through these. Georgia's number 1, South Carolina's number 2 overall ranking. And we've already been through these. I'm going to skip these slides. So they had business incentive programs. South Carolina was number 1 in the country. And then, let's see. So we're number 1. Unfortunately, when you compete with Georgia, Georgia's number 2. And then cooperative and responsive state and local government, South Carolina's number 1. Again, that's probably, y'all might not see a lot of that, but favorable regulatory environment, South Carolina's number 1. Speed of permitting, South Carolina was number 1. I'm going to skip through the rest of these slides because I've already been down them. Leading workforce development program, South Carolina 5. Available real estate, South Carolina number 1. Logistics and infrastructure, South Carolina 5. So this is another ranking. This is business facilities, their 2024 report. South Carolina was 10th for best business climate, 6th for automotive, 6th for EV industry investment. Fastest growing population, South Carolina 3rd. And I forgot to mention one thing before I got into my slides. South Carolina has a property tax program. One of the hottest things going now is worker housing, particularly in the urban areas. And South Carolina has economic development incentive housing if the county wants to give it to you. It's purely a county's discretion. It's called a special source revenue credit. So I've done several of them. So Columbia, South Carolina, for example, got tired of the university building the dorms and paying no property taxes. So they gave a 50% special source revenue credit for anybody who was building student housing, and it had to be a huge project. I think it was $45 million minimum investment. So I did 3 of those. So they cut your taxes in half. If 50% special source revenue credit cut your taxes in half. 25% special source revenue credit cuts it by a quarter. So they did that for student housing, and they got 3 huge student housing projects that went up as a result of that. For worker housing, some of the counties, and a lot of the counties haven't been asked, but some of the counties that have been asked have been given a special source revenue credit. And in all of them, it is market rate housing, which a percentage of it is dedicated to worker housing. And so usually, you the developer always push for the lowest percentage you can get. The county always, of course, pushes for the highest percentage you can get. But the norm is kind of 15%. So if you dedicate 15% of your market rate units to worker housing, you will probably get a special source revenue credit from the county. And the amount of that and the time period it lasts is subject to negotiations. But worker housing is probably the hottest thing going right now. It doesn't have to be apartments, it could be primary residence, but you don't see many of those. And it's got to be rented. It can't be sold to the person who lives there. It's got to be commercial, taxed as commercial. So that's something to look at if you're doing market rate housing. If you dedicate a percentage of it to worker housing, and you can give first priority to state and local employees, first responders, policemen, and that adds to the attractiveness of it. So if you got any questions to that when I get through, we'll go through that. CNBC also does a ranking each year. They don't particularly like South Carolina. It's kind of a woke ranking. So we were overall 27th, workforce 31st, economy 7th, infrastructure 8th, cost of doing business 13th, business friendliness 32nd, access to capital, we do poorly, no surprise there. Alex Laffer, ALEC rather, is a trade group, and Dr. Laffer does the report. So he does this every year, rich states, poor states. He loves a state that does not have one of the big 3 taxes, either don't have income, sales, or property. He loves those. So if you have all 3 like South Carolina does, you're never going to do too well. But gross domestic product 11, top marginal personal income tax rate 35th, quite high, where 50th is the worst. We're slowly reducing our personal income tax rate. Property tax burden 26, sales tax 21st. He's one of the few surveys that includes lawyers suing, and so state liability survey 37th, which is obviously not that good. We got we got some counties that give away the store. Electricity rates, we do well on that. 3rd lowest in the South Atlantic region. Industrial rate was the lowest in the South Atlantic region, and only 11 states had lower industrial rates, and most of those in the western states. Moving to South Carolina led the nation in terms of people moving last year. So it was the most popular state to move to, and twice as many people moved into the state than moved out. It also had the highest net searches per capita of all the states. Myrtle Beach was number 2 in the country, Somerville 5. Charleston's gotten so expensive, Somerville's all the rage now. Greenville 6, Charleston 20th. Unionization, you can't hardly, it's politically incorrect to talk about a low unionization rate anymore, and the unionization is the most popular in history, and young people don't have a problem at all with unionization. But we are, and the Department of Commerce used to brag about this. I'm not sure they even hardly mention it much anymore, but we were number 1 in the country and the lowest percentage of labor union participants. So then we move into state tax rankings. So that's the Economic Development Incentives rankings, state tax rankings. So the Tax Foundation, they are, I wouldn't call them right wing, I would call them pro-business and conservative, but they're well received or well regarded. So overall rank, we are 29th on the Business Tax Climate Index. And that's a shock to a lot of people. The 50th is the worst, number one's the best. People think, well, South Carolina's got to be in the top 3, correct? The lowest taxes in the country, right? Well, no, we're not. So overall rank, we're 29th. Corporate tax, we're 6, so quite low on the bottom. Individual income tax, 29th, and that's going down a little bit. Sales tax rank, 18. Property tax rank is what always kills us, 36. And unemployment insurance tax rank of 27th. And then COST does an annual survey. COST is like the U.S. Chamber of Commerce for state tax professionals. And so they rank them, and South Carolina got an F. Okay. And that's not, I always try to include North Carolina and Georgia because some of these rankings are, you know, they may just be anti-Southeastern, pro-union, so to speak. So, but North Carolina and Georgia did fine. We got an F. So there's only one ranking for property taxes for industrial, commercial, and manufacturing. There are a bunch of 50 state rankings for residential, but there's really only one for industrial, commercial, and residential, and that's the Lincoln Institute. And they do their update their study every year. So this is their most recent one. Commercial, which is mainly what y'all are. So they look at the largest city in each state, which in South Carolina is Charleston, and in North Carolina it's Charlotte. Then they also look at one rural city, which is Mullins. So of the largest city for each state, they actually have 53 rankings because they add, I think, Chicago, New York, and Washington, D.C. So there's 53 on the largest of each state, and on rural, there's 50. So in this ranking, 53rd is the lowest or best. Number one is the highest. So Charleston was 26th, I mean. And you know, for those in York and Lancaster that compete against Charlotte, Charlotte was 51st, meaning next to the last lowest in the country. And just to show you, you know, our competing, Nashville 39th, Atlanta 29th, Birmingham 37th, Charlotte 51st. Rural, of course, we do horrible. Poor Mullins pays some of the highest property taxes in the entire country. So for commercial, and so Lincoln Institute's a very sophisticated study. They do small, medium, and large investments for commercial. In South Carolina, we tax them all the same, but other states, sometimes it varies. And so they do small, medium, and large. Poor Mullins is 5th highest in the country, 6th and 7th, depending on the capital investment. And North Carolina rural is not nearly as good as Charlotte, but a lot better than Mullins. Then industrial property tax rankings. Again, they look at small, medium, and large, and I didn't put them on here because they've got so many. They're so sophisticated. They also look at small, medium, and large machinery and equipment. A lot of states that stacks differently, but I didn't have room to put them all on there. So Charleston, for a $100,000 manufacturing facility, 4th highest in the country, million 5th, 25 million 5th. Up until about 3 years ago, Columbia, South Carolina was the largest city, and Columbia was ranked on this. And Columbia was the 1st highest in the country. And as I said in my speeches when I was Director of Revenue, you know, Columbia wasn't amongst the highest, they were the highest property tax in the country on manufacturers. And so Charleston's 5th, Atlanta, you know, you'd see every state except Mississippi is a lot better than us. So this is 53rd is the lowest, number 1 is the highest. Jackson, Mississippi is the highest there. But Birmingham, Nashville, Charlotte, and Atlanta are all better than South Carolina. So that's what I just said earlier. When Columbia was the ranked city, it was number 1 in the country. So Port Mullins has, of the 50 rural jurisdictions, Mullins has the highest property taxes in the country for manufacturers. And of course, that Marion County can correct that anytime they want to through the special source revenue credit, which I mentioned earlier.
Bernie, how do our elected state officials justify these numbers?
The vast majority of them don't have a clue about these numbers. And so when I give this thing to county council, for example, they're dumbfounded. They don't have a clue that we're that bad. Probably nobody on Mullins County Council probably realizes they've got the highest property taxes in the country.
I'm sure Gary's, I'm sure Forrest doesn't either, do Gary.
Already Googled Lincoln. Check it out.
I mean, I didn't interrupt you, I just.
That's one of the reasons I ended up doing this PowerPoint. People just all think we got the lowest taxes in the country, and we don't. Okay. Remind me, which division did you work at in the DOR? Were you in sales? Income, yeah. So the elected officials just, they think we're the lowest, and they're shocked when they hear that we're amongst the highest. So this is apartments. Charleston's 20th, where number 1 is the highest, 53rd is the lowest. Port Mullins is 4th. So Mullins is almost the very highest in the country for apartments. Apartments are sometimes taxed a little differently, so Lincoln Institute separately does apartments and not just commercial. So taxes on commercial versus primary residence, South Carolina is the highest in the country, and taxes on an apartment versus a primary resident, South Carolina was the highest in the country. We used to not be the highest. We used to be like 3rd or 4th, and Boston and New York were ahead of us, and some way or another we've rushed to the top. So if you have a $300,000 law office and you have a $300,000 primary residence, the taxes on your law office are going to be 5.6 times higher than on your primary residence. And there's got to be a racial aspect to this if you assume that non-whites rent more than whites do. So we had, like, I don't have a slide on this, the 3rd highest car taxes in the country, 3rd or 4th highest car taxes in the country, and the highest differential of apartment versus primary residence in the country.
Well, that was brought on by Leatherman and that group, the 388 bill, wasn't it?
It was. And our property taxes changed quite a bit. And I represented the Manufacturers Alliance. So normally the Manufacturers Alliance fights, but you had opposing 388, you had the Municipal Association, the County Association, the School District Association, the Manufacturers Alliance, and the State Chamber. And I would have said, there's no way you're going to beat them. Well, they did beat them. And the reason they beat them was one of the very few bills I've ever seen where you had whites, blacks, liberals, conservatives, all saying property taxes are too high. They got a good crowd from Edisto Island, where I have a farm, and 60-year African American says I'm being taxed out of my house. I'm gonna have to sell it. That's pretty hard to go against that. So the guy who beat us was a rich Charlestonian who lived in a $4 million home, and he financed it and was sort of the voice of them. So rural industrial property taxes, Mullins is the highest in the country. And you see all our places it might compete with. So here's where the pendulum wildly swings back. All right, you've seen amongst the highest, but not the highest on commercial, amongst the very highest on industrial. Here's where the pendulum wildly swings back. So Lincoln Institute looks at 2 things. They look at the tax rate on primary residence, and they look at the tax bill on primary residence. So they look at Charleston. So Charleston's tax rate was 52nd, the next to the lowest in the country. The tax bill, you know, because every house in Charleston now is $1 million. The tax bill was 49th. And then Lincoln Institute hates property tax relief. So they looked at primary residence with assessment limits. As you know, our property can't increase more, if it's owned by the same person, more than 15% every reassessment cycle. So Charleston was the lowest tax rate in the country, and the tax bill was 51st. And you know, our General Assembly has spent so much time on primary residence and not helping commercial when we're the lowest in the country. Now, a lot of counties have higher millage than Charleston. You know, Charleston's so fabulously wealthy that their millage is a lot lower than a lot of counties. So primary residence of Mullins, of course, 36, where 53rd is the highest tax bill. I mean, is low, 50th is the lowest for rural. So the tax bill in Mullins is one of the lowest in the country. And then I'm going to skip through these or we'll be here all day. Could you pull up my next PowerPoint? He showed me how to do it. So I have 2 PowerPoints. It said it's loaded. You just got to pull it out. That's the one we just did. It's called Jobs Tax Rankings.
I don't have my eyes with me. Len, I'm gonna have to borrow your eyes.
Okay.
That's it right
This
there.
is right here?
Yeah.
Well, this is job tax.
Right.
Yeah. Okay.
Make sure it works.
I'm not sure how to get it into.
Now you got it pulled up. What is it not doing?
Here we go. Here we go. Yep. Now on this one here, you're gonna have to
Right.
use the arrows.
Okay. All right, so this is a very little known incentive, little known by y'all. It's very well known by manufacturers, warehouse, and distribution, but probably none of your businesses are taking it. And we should have had a packed room because one day an owner is going to hear me give this speech and go back to the office and say, well, I just heard Bernie talk, so of course we're taking the jobs tax credit, aren't we? And everybody's going to look dumbfounded. But the reason its profile is,
No?
I can't get either clicker to work.
You are up here on the screen.
Yeah, it's moving up.
Oh, I'll be damned.
That's why I was looking on your.
Oh, here we go. All right, so if you're in a tier 3 or 4 counties, and I'll tell you in a few minutes what a tier 3 and 4 county is, which is about half the state is tier 3 and tier 4. South Carolina has the highest tax credit in the country if you qualify for the jobs tax credit. So in tier 4 counties, it's $25,000 per employee. So it is highest in the country. And I watched it happen. I think the amendment was put on a bill, Economic Development Incentive Bill, as a poison pill. I think a Democrat who didn't like the bill put it on there thinking, well, this is surely going to kill the bill. Well, no, it didn't kill the bill, and they passed it. And the only reason it hadn't bankrupted South Carolina is nobody's ever heard of it. Nobody's taking it. So it's the highest tax credit in the U.S., $25,000 per new employee in Tier 4 and $20,250, then that's per employee per year for 5 years. So it's a nice credit. I'm gonna pull up so I can face the camera. My hand. You got to be a qualifying employer, and a home builder who's a general contractor licensed by South Carolina LLR qualifies. So if you're saying you have to, and so we're just going on, there's two kinds of tax credits. There's a traditional one, hire and maintain 10 new jobs, and there's a small business jobs tax credit where you only have to hire and maintain 2 jobs. So, but to get the small business, you have to have 99 or fewer employees worldwide. So if you're a general contractor licensed by LLR, and you have 99 or fewer employees worldwide, and you've hired 2 people, just 2 people, you qualify for the jobs tax credit. And the good thing is, and the reason why, if you're not the owner and you report to the owner, you have got to do this, is the tax credit passes through to the owner. If you're an S corporation, LLC, or a partnership, it passes through to the owner. So you say, well, I'm a home builder and I ain't really making a whole lot of dough, but my owner is married to a general surgeon and she's making about $900,000 a year. He passes through to them. If they file a joint return, it offsets that $900,000 that the heart surgeon's making. So it is a wonderful tax credit. Before we get too further into it, you can, if you say, geez, I qualified for this a couple of years ago, you can file amended returns and take it. And if you're in a Tier 4 county where $25,000 a year, you definitely want to file that amended return. All right, so we have 3 tax credit provisions: a traditional one where you got to hire 10 people, hire and maintain 10 people, an annual small business jobs tax credit, an accelerated small business jobs tax credit. So there's 3 kinds of tax credits, and these can get very complicated. When I was Department of Revenue Director, the longest policy document I signed was on the jobs tax credit. It's like 76 pages long. And when it's 76 pages long, it's plenty complicated, or it wouldn't be 76 pages. So there's a lot of guidance on it. So it's a credit against income taxes, corporations, sole proprietorships, partnerships, S, LLCs, any business entity, any for-profit business entity qualifies for it. You have to be a certain type of business, and you have to create and maintain a certain number of full-time jobs, which for the small business is just 2 jobs. You just have to create and maintain 2 jobs to qualify for it. And so the amount of the credit wildly varies, which I'll get to in a minute here. So it lasts for 5 years. So if you create 2 new jobs, you get the tax credit on them for 5 years. If you create more jobs in year 2, 3, 4, those jobs also count. So if you're in a Tier 4 county and you're a law firm in a Tier 4 county and you hire a paralegal, a secretary, and 2 other secretaries for a total of 4, $100,000 of credit a year for 5 years. Now you claim the credit in year 2, which I'll get to in a minute. So you got to be engaged in a certain type of business, and a corporate office facility is one of those businesses. And the definition of corporate office facility is a general contractor licensed by LLR. Now, I've wondered when I was doing this, LLR licenses so many people and so many things. Is it obvious what a general contractor is? Do they license numerous type of contractors and numerous slots?
They do.
They probably do.
A tier of 5.
Right.
Yeah, 5 tiers in the general contractors.
Okay,
Yeah.
so that is, by name, they call it a general contractor?
And you have levels. So
Right.
You can build up to 100 or 200,000,
Right.
100,000, 3 million, and unlimited.
So the statute is very specific. It says general contractor. So you've got to be a a general
See,
contract.
I think they're grouping all the residential people in what their language is. It's not what we can term a commercial contract. Don't you think so, Gary? Yeah.
The general contractor in the commercial side is tiered different.
Yeah, I've got one, I just didn't know, but I'm thinking what they did though, because that would be such a limited group of people.
Yeah, I don't think that's a residential building. Do you think that's a residential?
I think it is,
You think so?
yeah.
Okay.
It just uses the term general contractor.
Yeah.
Did y'all ever do any audits of jobs tax credits? Probably not a lot, did you? No, because nobody claims it.
Well, Gary's got what, 40 employees or more?
25, but
25.
you said law firms, so law firm qualify?
Law firms only qualify in Tier 4 counties, the poorest counties, whereas y'all qualify in every county.
What about if you have an office, a satellite office in a poor county, like Williamsburg and Marion?
They would probably just look at those employees.
Right.
So you couldn't include your Charleston.
I can
Right.
staff those offices for almost free
Right.
for 4 years.
Right. Exactly. Exactly.
Pay for the convention, didn't it?
I'll be sending you an email.
When you start reading the definition of what is a new job, your head's going to explode because you never hire anybody on January 1st, of course. And then people come and go. They never stick with you. So that's why there's the longest policy document I signed as a DOR director. It's just so complicated.
And that's just with the South Carolina income tax.
Correct.
Not
Which
federal.
buildings y'all?
It's just South Carolina.
Williamsburg and Marion County.
Yeah.
You know they Tier 4.
Yeah. I'm getting myself an office in Lee County.
Hey, I'll lease you a spot.
How do you know which
Marion-
ones are in
Williamsburg.
tier 3 and which ones are in tier 4?
I'm sorry.
How do you know which ones are tier 3 and which ones?
I'll get, the DOR annually publishes that list in an information letter, and I'll give it to you in just a minute here. It's on one of the slides.
I can reach you my whole upstairs.
So a retail facility or a law firm qualifies in a Tier 4 county. So in tiers 1 through 3, you got to be manufacturing, warehouse and distribution, or corporate office facility. In Tier 4, a convenience store, a liquor store qualifies. And we don't have Tim Scott's Opportunity Zone Act. He excludes all the sin businesses, massages, liquor stores, gambling. We don't exclude any of our massage businesses. Or any of our sin businesses. All right, for the traditional job tax credit, which if you have 99 or fewer employees, you ain't got to worry about this. They have to hire and maintain 10 new jobs. And the full-time job's got to be 35 hours a week, and 2.5 jobs, two half-time jobs of 20 hours can qualify as one full-time job. Seasonal employment is also an issue. We amended the statute for agriculture, so their seasonal employees qualify, but for y'all, a seasonal employee would not. The amount of the credit is determined on where the business is located. There are 4 categories of counties: Tier 1, Tier 2, Tier 3, Tier 4, and they wildly diverge. And I'll get to in a minute, wildly diverge how much they pay. You can lock in the credit by filing a simple form with the DOR. And people in Jasper should have done that last year. Jasper went from a Tier 4 county to a Tier 3. So for y'all, that wouldn't be any huge big deal because it went from $25,000 to $20,250, which is still very good. But a lot of businesses that were not in the statute, commercial businesses and service businesses, no longer qualify because Jasper's not a Tier 4 county anymore. Whereas if that business had filed a 616, they would have locked that in. Now, unfortunately, as you can imagine, a lot of the counties never rotate. You know, Williamsburg is not going to go off of Tier 4. But there are some counties that do, and one that I predict will likely go off is Cherokee County. I was surprised to see Cherokee as a Tier 4 county. So the basic amounts wildly vary there. So $25,000 for Tier 4, $20,250 Tier 3, and then it plummets down to $2,750 to Tier 2, and then 1,500 for Tier 1 counties. So the Tier 1 and 2 counties were asleep at the switch when this huge variance was put in. It can't. One negative is it can't exceed 50% of the taxpayer's income tax liability. And so where the credit is passed through, the heart surgeon, she's knocking back $600,000, and so she's paying $50,000 a year in taxes. It can only wipe out $300,000 of her $600,000. But there is a 15-year carry forward. South Carolina has the longest carry forward in the country. Most federal carry forwards are only 3 years. Ours is 15. So if you ain't profitable, weren't profitable during the pandemic, you still filed and claimed it because you then had 15 years before the tax man, that had to write a check to Ma Palmetto, as we say. All right, it's so you don't claim it year 1, you claim it in year 2 because you have to maintain the job for a year. And the calculation of full-time employees is extremely complicated because you never hire anybody on January 1st. So you got to have 99 or fewer employees for the small business, and you got to increase and maintain two employees. And the credit amount then, and this is where it gets a little bit complicated, is determined on where the employees are located. So there are 2 types of small business jobs tax credits. There's the annual, and that's where you have to hire and maintain for a year, and then you claim it on your tax return in year 2, and you file your tax return for year 2. And if you're like me, October 15th, so that's a long way off from when you created that job. And so the General Assembly recognized that, and they provided an accelerated small business jobs tax credit where you don't have to do that. So as we mentioned, it's created the year after the job has been maintained. And so there's a monthly and an accelerated. The accelerated one, you can file an election to compute it on a monthly basis and credit the year the jobs are created. And so if you know you're not going to be laying anybody off, you could go ahead and do that and get the credit a lot quicker. So the basic credit amount is substantial. It can either be a 100% creditor amount or a 50% credit amount. So the 100% credit amount is in Tier 4 counties is $25,000. The 50% credit amount is still very good. I mean, a $12,500 credit per employee ain't a bad day at the office. So either $20,000 or $25,000 or $12,500. So in Charleston, $750 is not a whole lot. So the 50% credit amount is if you pay gross wages at or below below the lower of state or county. And let me find it on my notes here. And then the 100% credit amount is if you pay your workers 120% or above of the county or state average per capita, which I'll give it to you in a minute. And so the state and county average per capita absolutely exploded during the pandemic. It's counterintuitive, gee, shouldn't they have dropped like a stone during the pandemic? No, they exploded. Now, whether they'll go back down as all that federal and state pandemic money is run out, I don't think so. So 100% credit amount, $25,000 in Tier 4. You got to pay the 2 new workers 120% or more of the county or state per capita. So the state per capita is $56,000. So 120% of the state per capita is $67,347. So you got to pay 2 new employees $67,347 in a Tier 4 county to get the $25,000 credit. So I'm going to quickly, and this took me forever I had to do this math myself, lawyers ain't the best at math. So I've given to you, if you email me, I've given you, this is the tier 1 counties. You'll see in Charleston, you know, you'd have to hire 2 people making $91,000, and the credit's only $12.50, so it's not hardly worth fooling with in Charleston. So those are the tier 1 counties. The tier 2 counties, you know, Berkeley's a good example. You got to pay $60,823 or above to get the 100% credit. And Berkeley, the 100% credit ain't much because they're a tier 3. And then there's a tier 3.
How the hell is Horry County in tier 3?
I know. It dropped down. It dropped down last year. It was a tier 2, and then it dropped to a tier 3. So some of that is just because it may be doing well, but one other county was doing a lot better because there's a maximum number of tier 2 and 3 counties. And then the tier 4 counties, as you can see, even in Williamsburg, you got to pay 2 people $46,000 or above to get the full $25,000 tax credit. So those numbers, to me, I was surprised how high all of these numbers are, and they just exploded. I went back and looked at 22 and 23, and the per capitas have just exploded. So as I say, there's a 100% credit and a 50% credit. To get the 50% credit, you've got to pay at or above the lower of the state or county, so most of the tier 3 and 4 are below the state per capita. So really, the state per capita really only saves, you know, the rich counties, and they don't hardly get any tax credit anyway. So you got to create, just to summarize, to get the 100% credit, you got to create and maintain 2 full-time jobs, paying gross wages at or above the state or local, the lower the state or county per capita. And then you can have 100% credit employees and 50% credit employees, which is actually fairly common. So some are going to be paid above the state or county per capita, and some are going to be paid below it. And so the Department of Revenue has very helpfully told you how to calculate that. So it can be very laborious. So the 100% credit amount, you have to look at each employee every year. Very complex. It's a huge pain. But, you know, if you're in a tier 4 county, it is well worth fooling with the math. So there's 2 policy documents on everything I've just discussed. The only confusing thing is the statutes have changed a fair amount since those policy documents were written. So the policy documents can be very misleading if you're not familiar with the law. You read something and no, that ain't the law anymore. Usually they almost always change in a pro-taxpayer fashion though, but they have changed. And the county rankings are done annually and the per capitas are done annually. It's a credit, not a deduction. The credit is, of course, a hell of a lot better than a deduction. It's not transferable, meaning you can't sell it or assign it. It's not refundable, you can't assign it, but you can pass it down to the shareholders. So if you have an S corporation, you pass it down to the shareholders. An LLC, you pass it down to the members, partnership to the partners. So in effect, you can sell it by somebody paying you to become a member of your LLC, and you can assign them all of the tax credit. And so typically they would be, and you would insist on this and they would insist on it, they would be a limited partnership. They would not be meddling in your business. They wouldn't have any voting power. And they'd want to be a limited partnership because they couldn't get sued when somebody fell off the building. So a limited partnership is and so basically they would pay you to be a limited partner, and you would assign them the tax credit. Now, obviously, for two employees, $50,000, it just wouldn't be worth all the lawyer and all that. But if you had 8 or 10 employees in a Tier 4 county, it would be worth doing, particularly since the credit lasts 5 years. You earn, when I keep saying the last 5 years, you earn it if you maintain those employees. You get that credit each year for 5 years, and any new employees you add during that time period. So there's 3 rules for the credit is applied against, and basically a C corporation is done by the corporation. S corporation is done passes through to the shareholders. LLC is passed through to the members. Partnership is passed through to the partners. So this would seem to me to be too good to be true, so I got the DOR to put it in writing. So the question is, you're a member of an LLC, and you're a member of several LLCs. So the doctor, the heart surgeon in Orangeburg, she's a member of her LLC medical practice, but she's got investments at a couple of other LLCs. So the question is, who takes the credit? The LLC, which in her case would be the medical practice, say she owned a percentage of a small warehouse and distribution facility. Who takes it? The warehouse and distribution facility, or her and her husband? And it's done. So what I always use is a heart surgeon. And there is a doctor in a Tier 4 county who's married to a very successful lawyer. And I assume they probably file a joint return. And so if they hired two new secretaries, the $50,000 a year credit would go to their income, to their tax return, their joint tax return, and not to the example I gave. There's a C-store. C-store ain't making any money, has losses, but the credit would flow down to their joint tax return. As I say, that seemed to me just too good to be true, so I got Jerry Lynn Van's story to write that into one of the policy documents. All right, so I just quoted the policy document.
Is it retroactive?
It's retroactive in the sense you can file amended returns for 3 years. So for a little while it wasn't retroactive because that statute had just passed. Now the statute's 4 or 5 years old, so it's everything I've just described was equally applicable 3 years ago. So the only thing when you file amended returns is you got to see if you were a Tier 3 or a Tier 4 county in that time period. All right, any questions on, so the first thing we went over, see, I think I'm well past my time, or no, I guess I got about 3 minutes. So the first thing we mentioned is if you are doing an apartment complex, and if anyone wants it, I'm going to leave my PowerPoint here, both PowerPoints actually, so I'll put them right up here if anybody wants all of these numerous statistics I've given. So the first thing we discussed is if you are doing housing, you can, if you will want to include a worker housing component, you may be able to get a special source revenue credit from the county. And it's a fair amount of lawyering, but obviously if you got a 25 or a 50% reduction of your tax bill, it's well worth paying Bernie a few bucks to do that. So the pushback from the county is what percentage of your complex is going to be worker housing, and then what special source revenue credit are they going to give you? And then on the small business jobs tax credit, you qualify, if you are a general contractor licensed by LLR, you qualify for the jobs tax credit. If you have 99 or fewer employees worldwide, you only got to hire 2 new employees, hire and maintain 2 new employees. And if you're in a tier 4 county, the highest tax credit in the country, $25,000 per employee. If you pay 120%, your 2 new employees make 120% of the lower of the county or state per capita. So it's lucrative. As you've heard me say 2 or 3 times, the only reason this credit hasn't bankrupted South Carolina is nobody's ever heard of it. Nobody claims it. So that's it for me. We got 1 more minute here before y'all go to your next panel. Any questions?
Thank you.
All right, thank you.
What if you have more than 99 employees? How many would you have?
You have to create and maintain 10.
On the first credit with the workforce housing, 15%, is a project have to be certain monetary amount. You mentioned that had to be multi-million, but
Richland County, to recruit student housing, they said you had to have a $45 million capital investment. That was just that one program. There is no, and there's no minimum otherwise though. So the county could do it for, Mullins would want to do it for a tiny little project, I would think. All right, thank you all.
Thank you.
Thank you.